January 22nd, 19. What am I thinking? 19 what? 2026. Oh boy, here we go. We've got an hour of great information on retirement accounts. David Moore, IRA Advantage. Thanks for joining us today. And it's first IRA presentation of 2026, and got some good information, hopefully stuff that will help people get where they want to go. It's been sort of an entertaining week on Wall Street. Think about Wall Street investments. And the reason I bring this up is a lot of times people are coming to us because they want to get off Wall Street's roller coaster. So you think about this week, we've had some ups, we've had some downs, and the old golden rule of never buying or selling on news just seems like that's all anyone does these days. So when we look at the whoop-de-doos, we talk about Wall Street's roller coaster. And what I mean is a couple days ago, we had a drop when we started talking about Greenland, whatever that means, a drop of about 1,000 points. The next day, all of a sudden, we're up 500 and we're up again today. But been entertaining. So we look at hard assets, tangible assets. That's why people come to us. They want to diversify their retirement portfolios into things that Wall Street may not offer, and I say may not offer as in, let's say, real estate, not a REIT, for example. A REIT, if you talk to somebody about diversifying in real estate and they tell you, well, hey, go buy shares of a REIT, that's a stock that's not going to give you the benefits and burdens of ownership of real property. Not that you're going to get that with a retirement account anyway. We're going to talk about these things. But people come to us because they want to diversify into hard assets, tangible assets. Maybe they want to do business startups. But when we're talking about these things, it's my brother's objective when we put IRA Advantage together in the mid 2000s was to accommodate our 1031 investors' wishes to be able to diversify their retirement accounts into more real estate, and that's resulted in lots of hard money lending, real estate investments, even real estate investment companies through what's called a ROBS, a rollover business startup. We've done car dealerships, we've done gold, silver, palladium mines, even hotels, motels, fishing operations, all with that rollover business startup structure. And then obviously lots of retirement accounts just for people that want to go out and buy things Wall Street doesn't sell. Precious metals is one of those hot topics these days, and lots of people want to do that, and you're actually able to go out and buy this stuff, and you can't put it in a safe in your house. People used to do that years ago with the checkbook IRA. That's not something that's looked upon favorably by the government these days, but it's not uncommon for people to have a safety deposit box someplace and at a bank, and they're putting the metals in that safety deposit box. But anyway, so physical custody is something that is possible. And then obviously crypto has been sort of an entertaining thing for the last decade or so too. So sometimes it's great, sometimes it's not. I'm going to leave that up to you. And with that said, I just want to stress that IRA Advantage, we do not sell investments. We don't get anything if you buy a given investment. We don't provide investment advice. We just listen to what you have and what you want to do with it and create the investment vehicle necessary to get you there. So my name once again is David Moore. My brother Tom and I started IRA Advantage in the mid 2000s with the help of family. Wives, I mean, and the other people in our firm at the time. And as I said, it was a result of people just wanting to do stuff. And what would happen was when we were researching, working on putting the business together, we'd go to these classes on how to do self-directed retirement accounts and solo 401k, stuff like that. And what would happen is we'd sit there all day long and find out how to make an investment into that sponsor's investment, but we didn't really understand. You weren't told what it took to put these accounts together. And so really what we did is we created a business that just puts those investment vehicles together for people. And it's a lot of fun. And so if you're looking at something, I'll just say in the taxed world, we're going to be able to accommodate you in real probably pre let's say 2017, we did lots of 1031 work on everything from businesses to investment cars, aircraft, a whole variety of things in addition to real estate. Trump's tax reform in 2017 took all the personal property away, and really what happened, and obviously I didn't like that because I like playing with those things, and we did lots of entertaining transactions with people in those spaces. That all got replaced with opportunity zones, qualified opportunity zones, QOZs or OZs. And if you look at those things, I think the original version of those, there was some abuse because these zones were actually picked by the governors of different states. If you're looking at two prominent projects in my region, I'm talking to you from Portland, Oregon right now. One of them was the Ritz-Carlton in the Pearl in Portland. Well, the Pearl District's not one of those things that really needs a lot of help getting economic stimulus to have a development made, and these developments were supposed to be sort of there to really turn a community around and improve things, which obviously the Ritz did, but that's a total high-end project. So that was something that was sort of the poster child for maybe what it wasn't supposed to be. An example of what it should be and what was a very successful project is the Vancouver Washington waterfront, which really sort of took a really a rough area and lots of not economic but environmental stuff going on there, and spun it around into just a wonderful project that's really turned a lot of downtown Vancouver around. So I think that's a great example of just a wonderful project and the impact it can have. The tax reform that was just passed this last year actually is going to take the QOZs and give it even a bigger advantage on things in rural areas. So if you're looking at something and you're in the tax world and you're saying, well, gee, I don't want to do an exchange, or maybe I can't do an exchange, maybe you sold a business or some other thing, even a home, let's say with gains in excess of the 250 or 500, Section 121 offers, that QOZ can be a great avenue to mitigate some of the tax consequences and really make a difference in a community. So we're not talking about tax world today. We're talking about qualified money, IRA 401ks, and what you want to do with that and what you can do with it. So this slide just talks about, we're here to help. Team Advantage is here to help with 1031s via Equity Advantage, 1031exchange.com, or through IRA Advantage with qualified money IRA 401k funds. And that's just iraadvantage.com.net. You're going to find us there. Something really helpful to us is if you've got questions, comments on content, or you'd like to see us provide some content, please don't hesitate to reach out to C Moore, CMOORE at 1031exchange.com. That's Celia, and she's the one. And furthermore, if you're a regional broker, real estate broker here, and you want some CE for this presentation, she's able to get that to you. So please don't hesitate to reach out. Let us know if you've got questions, comments, concerns on different things, or you'd like to see us address something. We're happy to do that. And the only dumb questions when you don't ask. So even if you're working with somebody else on some project, you got questions, you're not getting answers, reach out. We like to say we are the guys with the answers. So thank you for joining today. For future context, this is January 22nd, 2026. So the first thing I'm going to say is, your retirement account's your retirement account. That money is yours. It's not Wall Street's. And what we're talking about today is not new. It's been possible since retirement accounts were started. It's just a well-kept secret. And what we're really looking at is accounts that allow you to own everything you currently own, but anything else the law allows. And it really, why wouldn't you want that? And typically people come to us because they want tangible assets. Tangible assets are considered inflationary hedges. They're also considered to be something that's more stable in a turbulent time. So real estate's considered illiquid, therefore it doesn't suffer the whoop-de-doos that Wall Street might see. The downside is you can't just sell it if you want to eject out real quickly. Precious metals, also a tangible asset, inflationary hedge, and something that people reach for in times like we're in. And that's why you start looking at where we are today, and it's crazy. Precious metals, you going through, and just, I'm going to hold this up real quick. I think it's really interesting. Hopefully you can see this, but this is a sample of a gold bar that was supposed to be in Fort Knox. This was, my father was a dentist, and one of the labs had actually sent him this. And what's interesting to me, this was probably done in the 60s. and it said this bar would be worth, I think it says $560 or something like that, and it's 13 ounces. So actually 14.295 ounces. So you think about that. I did that math yesterday, and it's like 60 some odd $1,000 for this, which is pretty wild. And you start looking at that, you think about silver right now and where it's headed, just with all the electronics and the race for technology and everything that's happening there. So it's really enjoying a run up too. But you think about your ability to go do these things, and like I said, with a checkbook IRA, you can literally have, you know, physical custody of this stuff, put it in a bank account or in a safety deposit box someplace where you're not having to have the money across the country at some depository. You don't know the people, you don't know where it is, so on and so forth. And that's what people are, you know, looking for. They want stability. Now, something that's interesting to me is these hard assets, tangible assets, name an older investment than real estate or the metals, for example. And in both instances, these things are considered alternative investments, which just drives me crazy. I mean, name an older, more time-tested investment than either one of them, and yet they're sort of looked at as an alternative, something that's sort of outside the norm. And you know, a lot of times, I think the way it's termed, it might sound more risky. And I would say they are not alternative investments; they are real investments. Real estate is a hard asset. Precious metals are hard assets. So I'll get off my soapbox and get on, but I just think that's sort of interesting when we start looking at the way things are termed. And these are things that people, you know, come to us because of concerns, you know, in the economy. And really what happens is when Wall Street's going crazy, our IRA business slows down. And when it starts getting rougher or things get sort of uneasy, the IRA business picks up. And then the other thing that sort of drives things is when we have real rough times with layoffs and all, maybe the retirement account is literally a solution to the olive branch to your future. And so we work with a lot of people trying to sort of say, hey, okay, you're here. What are you looking to do with this stuff? What do you need to do with it? And how are we going to do these things? And what I want to stress is no matter what we're working with in this space, we're not taking money out of your retirement accounts. We might be shifting the type of account it is. We're typically rolling over funds, but this is not money being pulled out of a retirement account to go make these investments. We're just changing the structure. Maybe with an IRA, it's as simple as moving from custodian A to custodian B, or maybe with a 401k plan, it's as simple as changing the plan. So, you know, and the other thing I will say is a lot of times with 401k plans, I'll get an inquiry and somebody will ask, well, hey, can I do this? Can I do that? My administrator trustee says I can't. And I said, well, what's the plan document say? And they said, well, I don't know. I said, okay, we'll send it over and I'll take a look at it. And then, well, the plan document actually allows them to make that given investment, but nobody's really asked the administrator trustee about it. And then, you know, what will happen is they will either take a look at it and they'll say, okay, well, yeah, I understand. It does apply to what you want to do. We will make this happen, but we need this or that to happen, or we're going to have to review these investments. And what I'll say is about a self-directed account, the wonderful thing about self-directed accounts is they give you the ability to buy literally anything the law allows. The downside of them is it's up. It all comes down to you, and you've got to be very, very cautious when you've got a checkbook IRA, for example, or a solo 401k plan. You literally have power of the pen. You can make an investment by writing a check or wiring the funds into something. So you don't have safe, you know, guardrails there to make sure that you're doing this stuff. If you want to commit a prohibited transaction, you're going to do it. A prohibited transaction with an IRA means that all funds in that account are treated as distributed as of the first day in the year in which the indiscretion occurs, which that's a very steep penalty there. 401k plans, totally different situations. It's only the money involved in the indiscretion is treated as distributed. So two totally different consequences for the same action. And that sort of dovetails into, you know, how we're deciding what type of account is going to be right for you, what you actually qualify for. So these are things that in today's world, I'll tell you first up, work with a good team of professionals, people that understand this stuff. You're not paying them to learn. No such thing as dumb question. When we first talk to you, we're going to spend a lot of time going over stuff. Don't just expect to text us or email us and get an answer to something, because it is complicated. And the solutions might not seem that way, but as far as what you're doing and how you're going to get it done and what sort of speed bumps you're going to be looking at, those are all things we want to really look at in advance. And by the way, you need to make sure that before you go out and tie up a property or tie up an investment personally, think, gee, I'll just assign over the retirement account later. You cannot do that. So the reason I say you cannot do that is when we're looking at these investments, any transaction between or for the benefit of a disqualified party is a prohibited transaction. You're a disqualified party to your retirement account. So for you to tie up a property, even though let's say the property, the purchase sale agreement has an assignment provision and you think, well, hey, I'll just tie it up and sign over the retirement account later. That's a prohibited transaction because you have taken the property off the market. There's a benefit to the retirement account from your action. Therefore, that's a prohibited transaction. So when we look at these things, we want to make sure that you get everything set and ready to go before you make these, initiate some steps to make an acquisition happen. It's really important that you plan ahead and work through that plan so you know what you can't do and how you're going to do it, because you've worked hard for your money. We're going to work hard to keep it yours, but it really comes down to, in these situations, you've got to make sure every time you pull, if you got a checkbook IRA, every time you pull out that checkbook, you think, okay, what am I buying and who am I transacting between or for the benefit of? And those two are really the only two issues we're going to be concerned about to keep you going in the right direction. So, like I said, these things are not new. They've been around for a long time. When we look at self-directed, it's not a legally defined term. It's just a term that describes an account that allows you to go do what you want to do. And it's been possible to do this since retirement accounts were started in the mid-70s, period. That's all I'm going to say on it. Any IRA can be self-directed. If we're talking about 401k plans, we're looking at different circumstances here. If you're 59 and a half or older, you're entitled to take that money and roll it into something else. If you're under 59 and a half and it's a current employer plan, you're pretty much stuck. I've had business owners literally step away from their companies for a bit of time to get access to the money so they can go self-direct stuff. I had, before the last recession, I had somebody working, I believe it was, well, I won't name names, but one of the major truck manufacturers, and their 401k plan did not allow them to go to cash, and he was concerned about what was happening in the world, felt the recession was coming. He says, look, I can't afford to work another decade to get back to where I am, and I can't go to cash, and I don't want my money involved in this stuff. So he quit his job to get access to the money, and we self-directed it. And I honestly, it's been so long, I don't remember what he bought, but it was probably precious metals and some other things. But with 401k plans, if it's a previous employer plan, we can self-direct it, no problem. Current employer plan, under 59 and a half, we got issues. 59 and a half or older, then we can take and use that money. If we're looking at taking IRAs into IRAs, obviously a Roth's traditional beneficiary is one that's been inherited. All those things we can do self-directed accounts for. If we want to fund a solo 401k, single participant 401k plan, these are for self-employed people without employees. You can have a spouse as a participant too if they're working in the business. But if we're looking at funding a 401k plan, we cannot roll over beneficiary IRA, once again an inherited IRA, or Roth money into those 401k plans. Now, the 401k plan itself has Roth provisions in it, so you can roll funds from traditional to Roth inside those 401k plans. But actually populating the new plan, we cannot use beneficiary or Roth funds to fund those things. So, why do people come to us? What are they looking for? So typically, like I said at the top, they're tired of stock market's roller coaster, greater financial control. What do I mean by that? Literally buy anything you want to, anything you want to invest in that is legal. And the way the law works with respect to retirement accounts and potential investments, unless it's prohibited, it's therefore allowed. So the only things prohibited to invest in with an IRA are collectibles, life insurance contracts, or stock in a sub-S corp. So literally anything else is wide open. What typically causes problems is transactions between or for the benefit of a disqualified party. So tired of stock market's roller coaster, greater financial control, invest in what you know. Think about that. Invest in what you know. For some reason, our politicians seem to have much better ROIs on their Wall Street investments than we do. And for some reason, I'm not Martha Stewart's biggest fan, but for some reason, she's the one that got prosecuted and got in trouble for insider trading. There's no way you can convince me she's the biggest culprit in that space. I think they just tried to, somebody didn't like her. But you start looking at those things. In a Wall Street world, you can't, if you've got specific knowledge of certain events, that's not supposed to be able to be used. And as far as the self-directed world, it's wide open. If you're a mortgage broker and you want to take your retirement account and make loans with it, why not do that? Take advantage of that. It's there to give you a safe retirement. And so you should be able to increase your yield while reducing the risk if it's something that you have specific knowledge in. You're a real estate broker, real estate investor, and you want to take your retirement account, go out, make loans, or buy real estate and do all that stuff, you can do that. So why not invest in what you know? Hopefully the ROI on that investment is going to be better and the risk is going to be reduced. Increased investment flexibility. You've got that wide variety of investment options. Real investments, not alternatives. We talked about that earlier. Why are hard assets considered alternative investments when something like synthetic derivatives that put us into the tailspin pre-recession are let's say, established investments, but a real investment like metals or real estate is not. It's crazy to me. Notes and loans, community-based investing. You want to make a difference locally, you can do that. Invest in things where you can make a difference locally. Take advantage of today's opportunity. If you've got a checkbook IRA, solo 401k, you've got instantaneous investment that you can do. You want to go buy a property at a tax auction, you can go do that with that retirement account. Tangible assets, great hedges against inflation. Security, the money's literally where you put it. If you want to buy crypto, you can do that, and even a new business is something that's possible with a self-directed retirement account. Common objections. So when we talk to people about this, even though it's been possible forever, it's not something that's well known, and there's very little case law on it, and it's just sort of rare out there. There's not a lot of information out there. The tax and legal community, there's not a lot of knowledge available through them on this stuff. So really, when you're looking at this space, make sure you're working with people that have been through this for a long time. They've got years. They can talk about the stories, tell you the stories of what people have done, what, the successes and failures. There's definitely failures there too, with any investment. But make sure you're working with people. You're paying for knowledge, not paying for people to learn. And when we look at common objections, when you talk to your tax or legal people in this space, what will happen is they'll typically come up with these four. Loss of long-term capital gains tax rate. So say, okay, you talk to your financial advisor about taking your money and going to buy real estate. And first thing you're going to say, well, hey, just go buy a REIT. As I said earlier, a REIT is not real estate. A REIT's a stock that owns that entity owns the real estate, but you're not getting interest deductions, depreciation, or anything else. Now, I want to caution you on that because your retirement account is not you, and the retirement account's not going to have those interest deductions, depreciation either. Now, it could, and the only time it could is on leveraged investments. So what I mean by that is a leveraged investment would be a property you've got a loan on. Two big issues here. One, that loan is non-recourse to you. Once again, your retirement account is not you. Whatever your retirement account owns, that is not you. If you buy a piece of property with your IRA LLC or a solo 401k plan, that property is not an additional asset on your homeowner's policy. That is not you. You're going to have a new policy in the plan's name and EIN, or you're going to have a new policy in the IRA LLC's name and EIN. Any expense associated with those investments is your retirement accounts, and any benefit of those investments is also the retirement account. So don't think, hey, I'm going to go out, I need more money, I'm going to go take my retirement account, go buy this apartment building, and that way I'm going to gain all this additional revenue annually. No, you're not. I mean, you can, but you're going to be taking that money as a distribution at some point. You're not just going to be taking it. So whatever that retirement account owns, it owns, you do not own. The tax consequence, if we look at 1031s, for example, you sell something, you pay the tax. You get the exposure, or you do an exchange to kick that tax liability down the road. Everything's going to be tax deferred. If you want to swap till you drop, it's possible in today's world to swap till you drop. At that point, your heirs receive the property, your property's stepped up basis. They could turn around the next day and sell with no tax. So it's a wonderful thing. If you sell and pay the tax, you're going to be typically looking at any asset that's been held as an investment for in excess of a year. You're looking at long-term capital gains tax rates. Anything in your retirement account that you take out, you're paying normal income tax on, period. That's the way it is. So a traditional IRA or 401k is pre-tax money growing tax deferred. You pay tax on distributions. Back to my apartment complex example, you take your retirement money, go buy the apartment complex, and you want to live off some of that money. If you're 59 and a half or older, you're going to take distributions. Maybe you take them a couple times a year. Don't do it every month because there's fees associated with that, and it gets complicated with distributions. If we're looking at IRAs, 401ks, maybe that's not an issue for you. But you just have to sort of look at the path between that retirement account, you, and what's involved with it, and you can decide at what point you want to take distributions, but that's possible. But the benefit you're gaining is via distributions. It's not something that you're able to just take that money. And furthermore, like I said, the retirement account's typically not going to have any depreciation or interest deductions. Now, it is possible with an IRA, through a leveraged investment. So one, you'd have to have non-recourse debt. That loan is not attributable to you, your credit, your income, anything else. The asset's got to stand on its own. If you're concerned or considering an IRA-owned investment and you want to look at debt on those things, take a look at myiralender.com or iralending.com. North American Savings Bank has a whole division. Matt Allen there, I believe it's Matt, I can't remember for sure. It's been a while since I looked at the book, but he wrote a book on this topic, and these guys specialize on it. It's typically going to be a little bit more money, but in the default, they can't even go after anything else that the IRA owns. They can only take the asset that they've loaned on. So typically you're looking at a lower loan to value, you're going to have slightly more expensive money, but these companies are out there to provide that debt for you. Don't go walking into your normal lender and expect them to provide an IRA compliant loan for you. So when we look at these objections, once again, loss of long-term capital gains tax rates, you don't own it, okay? So with a leveraged investment, maybe your tax people are going to take some of those deals, because with an IRA, if you got a loan on a property that's 50% loan to value, you're going to have tax exposure on the income or gain attributable to other people's money. That's unrelated business taxable income, and there's going to be some tax exposure. Even with a Roth IRA, you'd have some tax exposure on that. The other time you have tax exposure with a retirement account is if you're conducting business with it. So even with a Roth IRA, if you go out and buy something that's a business, a laundromat, for example, that's a business. You think, well, gee, it's an investment. It's not. I mean, you're buying it's going concern, so you're going to have some tax liability on that unrelated business taxable income once again. What's interesting is a 401k owned asset with leverage, you don't have that same UBTI issue that you do with an IRA. Why? I don't know. Some senator had a 401k plan. Second, so sort of dovetails into the second example, cannot be leveraged. Totally wrong. Okay, you can leverage an IRA or 401k owned investment. It's just got to be non-recourse debt, like I said. 3, what about RMDs, required minimum distributions? So the idea, once again, real estate's not liquid, therefore you hit RMD age, and now you've got to take a distribution, and let's say you don't have any cash in that account to take the distribution. Now you're going to have a penalty. So what can be done, though, and this is something that's just not contemplated by Wall Street typically, is you can take in-kind distributions. So instead of taking a cash distribution when it's needed or necessary, you can take, or even desired. We have lots of people who just want to desire, they desire to take those distributions. But when you get to that point, the RMD issue, if you don't have the cash to take it, you can always take in kind. And it's even possible, this is where the tax planning comes in, if you're looking at transferring an asset. A lot of times people will buy a property, maybe they buy a beach property, ultimately want to retire into it with their IRA 401k plan. Well, you can't use it or benefit from it directly in any way until it's been fully taken as a distribution. But and what you distribute is the equity in that investment. But if you're looking at taking minority interest distributions, you can actually discount the value of the distribution. So talk to your tax people about that. They got questions, have them talk to us. discounting minority interest is common when we're looking at estate planning and gifting. That same strategy can be used on in-kind distributions of minority interests on things. And that's something you'd want to be working with your tax people on and possibly your legal people on. But, you know, imagine you've got a place at the beach, you ultimately want to retire into it. We might create a limited liability company to own that asset. And then maybe over a series of years, you're just taking assignment of membership interest in that limited liability company that ultimately transfers ownership from the retirement account to you over a series of years. While it's minority interest, maybe you can do the discounting. As soon as you have a controlling interest, now you got control, the discounting goes away. But this example of RMDs and your inability to take one because it's a hard asset that's not liquid, that can be accommodated, taken care of with in-kind distributions. Finally, you lose interest deductions, depreciation. I sort of hit on that a couple minutes ago. If you've got an IRA-owned asset, even Roth IRA-owned asset, and you've got a leveraged investment, 50% loan to value, for example, half the income and half the gain you're going to have tax exposure on. And typically, we're not going to be in a situation where if you own it outright, you're not going to have interest deductions, depreciation. But if it's a leveraged investment, your tax people might work with you to take some of that. And once again, it's not you, it's a retirement account. If there's a tax liability in a given year, it's not yours, it's a retirement account. So keep that in mind. And that's why we really want to look at this stuff and plan ahead. I mean, if you listen to some of our old presentations, I talk about diving or flying or even floating a river. I mean, if you're a scuba diver, the idea is you plan the dive the plan. If you're a pilot, you're always going to file a flight plan. If you're a boater and you're taking trips, you're always going to be doing that float plan and letting people know what's going on. But you plan it out in advance, and then you follow that plan, and that way you're going to be safe. But if you start, going through, by the seat of your pants, and you want to do this or do that, self-directed accounts, they do offer the opportunity to get yourself in trouble. So make sure that every time, if you got that checkbook IRA, every time you pull out that checkbook, what am I doing with that check? What am I paying for? And who's it benefiting? And making sure that it is for that retirement account, period. So your retirement account is not you. I like to say it's Susie down the street. You're not going to pay for her expenses. You're not going to take her money. You're not going to insure her stuff. It's hers. So anytime you look at that retirement account, think of it as somebody else, and you've got control of it, but it's not yours until what is in it is taken as a distribution. Is this stuff complicated? No, it's not complicated. It's just confusing. And you've just got to really look at this. And I just said it, and this page spells it out. There are two issues that I'm concerned about anytime we have any transaction with a retirement account. What does the person want to invest in? And who are they transacting between or for the benefit of? And when we're looking at the investments, I said it earlier, unless it's prohibited, it's therefore allowed. The only prohibited investments for an IRA are collectibles, life insurance contracts, or stock in a sub-S corporation. A 401k plan's sole restriction in investment is collectibles. So you name it, you can probably invest in it. What gives people problems is transactions between or for the benefit of a disqualified party. Who's a disqualified party of the retirement account? You are, your spouse is, your lineal ascendants, descendants, their spouses, and any other entity owned and controlling interest by one of those disqualified parties. What about siblings? What about aunts and uncles? They are not disqualified parties. If we're talking 1031 context, we're looking at related party rules that sort of tie things up with siblings and aunts and uncles, not so much, but parents. But when we're looking at retirement accounts, if you, let's say you find that property, you've got to make an offer on it today. You got to tie it up. The retirement account's not set up yet. Get your brother or sister write the offer, and that would be fine. They can then assign that offer over to your retirement account when it's set up, but you cannot personally go and do this. All right, it needs to be structured in advance. Now, when I'm on this topic of structuring it, a 401k plan we can get together, and you can probably get it funded within a week or two. A checkbook IRA is probably going to take the better part of a month to get it done. If we're doing a rollover business startup, that's once again probably a week or two to get it handled. but it takes some time to make things happen. The thing that's toughest about any of this is just moving the money around, because a lot of times it takes, Wall Street just is slow on moving those funds because they've had it and now you're taking it from them to put it someplace else, and then you've got to liquidate the assets and then have it clear, and then they may or may not, a wire of funds from that entity to the IRA LLC's checking account or solo 401k plan's checking account. Maybe they're going to just mandate a check be written, and all that stuff just takes some time. So what type of account do you want or do you need? And really, this is sort of the four that we work in day to day with here at IRA Advantage. And one's a basic self-directed IRA. Basic self-directed IRA, what we're doing is just moving the money you want to use. It's not all or nothing. So I would say with an IRA, any IRA, whether it's checkbook or basic, I would say leave the Wall Street stuff where it is. Just leave it there because it's safe there and it's segregated from the self-directed accounts. With IRAs, like I said, a prohibited transaction will treat all funds in the account as a distribution. So I think it's really important to keep the Wall Street stuff where it is. Only move what you want to use in the self-directed capacity into the self-directed account. And what we're doing, the most basic way to look at a self-directed account is simply moving the money from a trust company that won't allow you to do what you want to one that does. And that is typically just going to be a rollover from that Wall Street account into the self-directed custodial account. A basic account means that the owner of any given investment is going to be that trust company. And it's going to read, like if we're looking at a title to it, it would just read, ABC Trust Company, CFBO Custodian for benefit of, Susie Jones, IRA number, whatever it might be. Okay. The issue with a basic account is if it's for infrequent, non-time sensitive and management free investments, it's great because it's inexpensive and it's very little to keep this thing going. I mean, you can go online to many different self-directed custodians and just fill out an online application, get that thing put together and get it funded. The issue is that when you start looking at, if you want to buy real estate, for example, and you want to manage it, there's really no way to use that basic account. And just think about even making an offer on real estate. Who are you writing the offer between? I've already told you it can't be between the seller and you. If it's a basic account, the legal owner is going to be the trust company for benefit of your IRA. So do you have the power of the pen for the trust company? So who even signs the purchase sale agreement with a self-directed IRA? If you're a broker and I come to you and I say, okay, hey, Susie, I want to go and buy this property with my IRA account. You cannot write it between the seller and me. It's got to be between me and either the trust company, or not me, I'm sorry, the seller and the trust company, or the seller and my IRA LLC. So if you're a broker and somebody comes to you and says, hey, I want to buy this property, your first question is going to be, what type of account? One, is the account established? Because it takes time, as I said, to put together. But two, what type of account do I have? If it's a basic account, you're going to sort of go, oh, I don't really want to work on this, because who's signing that purchase sale agreement? When you need earnest money, where's that earnest money coming from? It's all going to take time because everything's got to run through the trust company. If it's a checkbook IRA, that's an easy transaction because you're just writing the offer between the seller and an LLC that the taxpayer, me, if it's mine, I'm the manager of the LLC. The member's the trust company for benefit of my IRA, but I'm the manager. It's a manager-managed limited liability company. I have the power of the pen to write that offer. So you just write the offer between the seller and the IRA LLC, and it's an easy deal to get done. So basic accounts are great if you're going to buy, let's say into some fund or buy into something. You've got a buddy that put, maybe you're aggregating funds to go buy some property or do some other project. That basic account's going to get you there. A checkbook IRA is going to give you control and ease of investment, immediacy of investment, and it's going to give you the ability to manage a property. So in a checkbook IRA context, the trust company is not the owner of the ultimate investment. The trust company is the member of an IRA LLC. So we're going to create the custodial account. We're going to create an IRA-specific limited liability company. As soon as that's all set, you're going to go to a bank, open a bank account in the LLC's name and EIN. You're the manager, the member's a trust company. And as soon as that account's open, you're going to get the information to us. We're going to direct the trust company to make the investment in the LLC, funding the bank account. Now you're free to go buy what you want to buy using that limited liability company. So that's a great tool. Immediacy of investment, like I said, allows you to manage the assets. You want to go buy the property. As I just said, you're going to be negotiating between the seller and the LLC, and you go forward very easily. So people with IRAs that are retired, or people that own businesses but they have other employees where a 401k plan really, could not be used or should not be used, that checkbook IRA is a great vehicle there. A solo 401k is something that's, I think, wonderful, and the perfect investment vehicle for somebody that's self-employed without employees. You could have your spouse as a participant if the spouse is working in the business too. So a solo 401k is just a single participant 401k plan. So when you've got that, we can fund that with traditional IRA money of any form, or previous employer 401k funds. We can form that new 401k plan. We're going to get you the plan. We're going to get you the EIN. You're going to go to a bank, open an account in the plan's name and EIN. You as trustee have the power of the pen. So to make an investment, it works just like that checkbook IRA. If you want to take it a step further and integrate a limited liability company, it's not necessary. But if you want that also, you just have in the plan as the member of the limited liability company, and you can buy whatever you want to buy with that structure. It's a great thing. And 401k plans, once again, the only restriction on investment is collectibles. Finally, the rollover business startup. Rollover business startup allows you to literally create a new business that you work for and take compensation from. So what'll happen in that situation, so an IRA LLC, a checkbook IRA, is a combination of an IRA and a limited liability company. A rollover business startup is a combination of a 401k plan and a C corporation. And we've done, like I said at the very top, we've done rollover business startups for everything from real estate investment companies, hotels, motels, Alaskan fishing operations, mines, car dealerships, all kinds of stuff with that. But it really, mattress companies, we've really, with that business, it's one of those things that allows people to go out and create the life that they've always wanted, maybe. And some of it, really, if I'm totally transparent on this stuff, during the last recession, we had people that lost their jobs and we're looking just desperate, looking for a way to go forward. And if you look at the franchise world, they know of the rollover business startup, or ROBS, and they will often look to a potential franchisee that maybe says, well, he or she doesn't have the money someplace. So I'm, well, hey, do you have money in a retirement account? And once again, we're not taking money out of the retirement account. So you're not paying tax and penalty on that money. We're just, creating the investment vehicle that includes a new retirement account. And once again, for that business startup, we're talking about a 401k plan, so we cannot migrate or roll over Roth IRA money into that 401k plan, nor could we do an inherited IRA, beneficiary IRA, to fund that 401k plan that's necessary to invest in the C corporation that owns the business. But these are 4 different big options there that are all there for you and provide different opportunities and benefits and pitfalls. But we can help you with any of those. As I said, any IRA can be self-directed. We have to be careful when we're looking at 401k plans. Under 59.5, you are looking at a situation where if you take money out, you're going to have an issue there. And typically you're going to be looking at tax consequence and the funds being pulled out plus a 10% penalty. If you're under 59.5 or older, then we can actually use those funds as you choose. So previous employer plans are going to be fine. Are these things tough to put together? No, they're not. If we're looking at IRAs, we're just changing the custodian. As I said earlier, it's possible a lot of these self-directed trust companies will have an online form and you can fill it out. And one of the forms that's filled out is a transfer authorization form, which allows them to go to your current custodian and say, give me the money. you need to make sure that you have instructed your current custodian to go to cash in the amount that's requested, because if the request comes through and there's no funds there to fund it, it's going to bounce, and then you're going to be sitting there waiting. So as I said earlier, probably the toughest thing about any of these accounts is getting them funded. It just takes time, and you've got to be ready to do it when you want. So, pretty easy to do that. If we're talking about 401k plans, we're really just going to, if you're funding a checkbook IRA LLC with a 401k plan, then you're going to be working with the trustee of the plan and filling out paperwork to initiate that transfer from the 401k plan into the new checkbook IRA. If we're creating a new solo 401k plan or 401k plan for Robs, then once again, you're going to be initiating the paperwork into that stuff. And we're just, rolling from one 401k plan to the next. And I made a comment earlier about, sometimes trustees, administrators not understanding what is possible or what their accounts, what their plans actually allow as far as investment. If you've been to my presentations before, you probably heard me give you this example, but I think it's a great one, because we've got a good client, a 1031 client and IRA 401k client. And he's an ex-IRS auditor, CPA, and real estate broker. And he wanted to put some money into an institutional tenancy in common project a local sponsor had put together. And so he came to me and said, hey, David, can I take my 401k plan and go make this investment? My administrator's telling me I can't. And I said, well, okay, so let me take a look at it. I take a look at it, the plan allowed that investment. So I said, okay, hey, Cameron, talk to him, tell him right here, page this, paragraph this, section this, paragraph this says that you can make that investment and see what they have to say. And they still denied it. So I said, okay, well, let's get them on the phone. And so we sat and talked to them. And I basically got down to the point. I said, look, you can accommodate his desire and keep him as a client. If you don't accommodate his desire, then he's just going to terminate his relationship with you, and he's going to become my client. And I've been doing this long enough where I don't have to do every deal, and I'm here to help. And in this situation, it made sense for Cameron just to keep working with them. Just economically, it made sense. Time-wise, it made sense, because the time to make the investment was pretty close in this situation. And I would have preferred, hey, if we can just get these guys say yes, let's do it. So finally, we got them around to the point where they said, yeah, okay, we acknowledge, yes, we can make this investment, but we need 60 days to review the investment, which put them outside the time horizon that investment needed to be made. So we ended up taking and creating a new 401k plan for him. But that was a situation where really he didn't need to make the change. The plan allowed it, but people involved with that plan didn't even understand what their own plan had to say or what it allowed as far as potential investments. And then when it actually push comes to shove about how they're going to vet a given investment. 60 days to vet an investment, give me a break. A couple days, yes. And that's sort of what comes down to with a trust company, a basic self-directed IRA, for example. The reason I say it doesn't allow immediacy of investment is because they're going to sort of check it out, make sure it fits. Now they're not going to decide whether it's a good investment or bad investment. They're just going to decide whether it's a qualifying investment. All this speed talking, I'm running out of time. So when we look at this basics with an IRA and creating that custodial account, you might find you're sitting there going through stuff and you think, okay, hey, I want to use these guys because they're cheap. I'm going to sort of caution you against that. It's your money. You want to make sure they're good and solid and they're going to be around, right? So if it's a basic account, they're the custodian of that investment. They're technically the legal owner of it. So you want to make sure that they're there and you like them. And so I'm always going to look at time, security, and time in the business, because in a 1031, for example, I always say, look, what good is a 1031 into this new investment if the investment goes away? So what good is deferral if what you buy doesn't work out? So I think with retirement accounts, and what's interesting to me is in a 1031, people literally give me their money. I rarely see them. I might have a 1031 client for decades and never see them. We do a retirement account for them. They're in my office. Say, okay, so hey, I'm happy to see you, but why now after all these years? Because I don't even touch your money with the IRA. And they say, well, this is my retirement account. So I don't know why people look at that, but they're typically more conservative with the retirement accounts than they are in the 1031 space, which I would say, once again, is retirement money. But anyway, So with that said, when you're looking at a trust company, you want to know, time, security, time in the business, obviously the cost important, but you also, what's really important is you want to know how they charge, what those fees are going to do for you, and how they're charging you. And what I mean by that is there are trust companies that are going to charge you by investment. There are trust companies going to charge you by the value of your account. Now, if you got a Wall Street account, you've got a financial advisor that's charging you to manage money and it's based upon the value of the account, you want that thing to be worth a lot. You want it to be doing great, and you can at any given moment, you've got a snapshot of what every investment you've got is worth based upon the stock quote price, right? Whatever it might be. Even metals, you've got a minute by minute, second by second value that's there. What's a piece of property worth? What is a note worth? Who knows? And so when you're looking at self-directed accounts, you don't want to be fighting with the trust company about the value of what you own. And so I'm going to tell you, if you're looking at self-directed accounts, don't work with a company that's charging you based upon the value. Work with a company that's based upon the number of investments you've got. Well, gee, David, I'm going to have 30 investments. I don't want to pay them all that money. Think about this. An IRA LLC means the trust company has one investment. The LLC has those 20 or 30 investments. They're charging you based upon the one. Finally, you want to know what that trust company's requirements are if you want a checkbook IRA or IRA LLC, because some trust companies will not allow you to be the manager, which totally defeats the entire purpose of the checkbook IRA. Others will require that your tax or legal people sign a document stating they're experts all things IRA, which my experience is they don't want to do. Others might have a third-party review that's annual that needs to be done, but just understand what those rules are. If you're working with us, we work with a variety of trust companies. We know what they want. We know what they need. They know our contracts. They know our limited liability companies. And by the way, don't think that you're just going to go out and go get a regular limited liability company operating agreement, get it approved by the trust company. It's not going to happen. So make sure that what you're working with, and please don't get these things and put them together and then come to us, because we quite often end up having to restructure everything. If you've got the custodial account, great, but I really want to encourage you to, heed my warnings on how they're charging you, what they're going to require for that limited liability company. The immediacy of investment too, what's their investment policies? Obviously the costs are all important, but those are factors to consider when you're looking at a trust company. If you're working with us, we're going to be talking to you about a couple different trust companies that we work with all the time, and they know us, we know them, and we know how it all works. What investments are possible? We've talked about this, so I'm not going to burn any more time on it. IRAs, anything other than collectibles, life insurance contracts, stock in a sub S corp, 401k plans, anything other than collectibles. How about real estate? When we start looking at real estate, what kind of real estate can somebody buy with a retirement account? Rental houses are yes, apartment buildings, office buildings, retail centers, land, any property to be held for investment, a future retirement home is fine. You cannot buy a primary residence, second home for a disqualified party, an office building to be used by a disqualified party. So you can't go buy a quote unquote investment property using your retirement account, put mom in or junior in while he's at college for hopefully 4 years. Anyway, so you sort of get the idea there. You can't buy an office building that your company's going to occupy. It's got to be for investment, and it's got to be used by people that are not people or entities that are not disqualified parties to you. Disqualified parties, we've talked about this, but I think it's really important to understand that, since that rarely is the investment a problem. The prohibited transaction typically occurs when we've got an issue between a benefit to a disqualified party, let's say. So lineal ascendants, descendants, their spouses, any legal entity owned and controlling interest by one of those are all disqualified parties. And once again, siblings are not. So you couldn't buy from a disqualified party, sell to a disqualified party, loan to, borrow from, and have people in those things. So just be careful when you're looking at those transactions, and how ultimately, if you buy something, well, David, you talked about a situation where I can retire into that beach property I bought with my IRA. Yes, you can, but you're not going to use it in any way or benefit from it in any way until that asset's been taken entirely out as a distribution or a series of distributions. So yes, it is possible to buy it, but you can't use it until it's been taken as a distribution. In-kind distributions. The great thing about in-kind distributions is you can take them. The downside of an in-kind distribution is typically people take a distribution out of their retirement account, and there's going to be a tax. You take 10,000 out, you're going to pay, maybe you're losing 3 or 4 in tax, but you got the money to pay the tax obligation. In-kind distribution, you're taking something out, triggering tax exposure, but you're not receiving the cash to pay the tax obligation. So it's important to be aware of that. If you take an entire property, I think a great solution, whether you're talking about taking a property as a distribution or maybe doing a Roth conversion of an asset owned by your IRA, what can be done is you take the distribution, then you do a cash out refinance of that property to pay the tax obligation. Whether that's a Roth conversion or a distribution, either way can be done. If it's a rollover from traditional Roth money, then that subsequent refi needs to be non-recourse debt to you. If it's a distribution of the asset, now you own the asset, then go out and just talk to your, whoever you do work with as far as lenders that can do cash out refis and use that money to pay the tax obligation. Examples of prohibited transactions, we talked about that a minute ago. Assignment purchase sale agreement from taxpayer to IRA LLC, recourse debts, no contributions, distributions directly between the IRA LLC and account owner. Now, we haven't talked about that. We talked about a checkbook IRA and sticking that IRA specific limited liability company. That's what the investment, that trust company makes the investment in the LLC. The LLC then owns everything. So if you want to make an additional, let's say you need more money in that account to cover some expenses, and when we fund these things, if you say, hey, David, I need $250,000 to make this investment, I'm going to say, let's put 275 in there or something, or 300, so you got money there, because inevitably you might have some costs before you've got cash flow that's taking care of things there. So when we're looking at an additional contribution, you're going to make the contribution to the trust company makes an additional investment in the LLC. Now the LLC's got money. You want to take a distribution, the money's going to go from the IRA LLC back through the trust company, then to you. We've got a bubble chart, another page or two, we're going to talk about that. Working on IRA-owned assets. Sweat equity is not okay. So if you got a property that's owned by your IRA 401k plan, you cannot work on it. I'm going to say that again. You cannot work on the property that's owned by your retirement account. That's a prohibited transaction and will be considered a prohibited transaction. You're going to have a tax consequence on that. So do not do that. Buying or selling a property to a disqualified, buying from or selling to a disqualified party, prohibited transaction. Personal insurance policy to cover IRA 401k owned assets, also a problem. IRAs, all the funds in that account are treated as a distribution as of the first day in the year in which indiscretion occurs. So do not do that. 401k plans, totally different situation, only money involved with the discretion. So once again, these are accounts, even though it's ultimately your retirement, it's not you. Don't treat it as you. It's a separate entity, separate tax consequence. If there's a taxable event on that unrelated business taxable income or something like that, it's not your tax liability, it's a retirement account. So you got to be aware. And once again, my comment about overfunding, just make sure you got enough money in there to cover things that you might not expect to see. So can I do this? Can I work on property owned by a retirement account? We said no. Can I guarantee a loan for the retirement account? No. Can my business occupy a building owned by my retirement account? No. Can I write off expenses for travel? This is one that comes up. Hey, gee, I'm going to fly across country, or maybe I'm going to Mexico to look at the property. Maybe I'm going to Italy to look at my property. By the way, if we're looking at 1031s, it's domestic property for domestic, foreign for foreign. We can't take a domestic owned property and exchange into some foreign property. Retirement accounts, you can go anywhere and do this stuff. So, but you're not going to be, it's not your expense. You cannot write off these trips because you don't own the asset, the retirement account does. So just be aware of that stuff. Creating these accounts, we've talked about this, probably not going to talk about it right now. You can do it online. It's pretty simple if you want to. If we're talking about basic account, we're talking about checkbook IRA, it's going to require a lot more time, energy, and it's got to be done correctly. So, give us a call. We can take care of that stuff. As far as the 401k plans, it's really easy. But this is a bubble chart talking about a checkbook IRA. So if you look at over here, we've got the source of funds, whatever it is. We're going to create the necessary custodial accounts. If you want to combine let's say you've got traditional IRA and Roth IRA money and you'd like to use both of those accounts to go make investments, you can do that, and we can do it either. So it's going to require a different custodial account for each of those different types of accounts, and then we're going to have each of those different accounts make the investment in the IRA LLC. So this IRA LLC can contain a single IRA, it can contain your IRA and your Roth IRA, it could contain your IRA and your spouse's IRA, it could actually contain your IRA, your spouse's IRA, and personal money even. That's a complication there, because we've got now an entity that has a bunch of disqualified parties. So when we look at a prohibited transaction with disqualified parties, that can be a prohibited transaction. It's a prohibited transaction to transact between or for the benefit of disqualified parties, not a prohibited transaction to transact along with one. So it's possible to combine all those different funds into a common LLC and then make those different investments. We want to overfund the LLC's investment, because after we fund it, we can't have additional money coming in from these disqualified sources. There are trust companies will allow additional investment as long as it's pro rata. So whatever, if it's 33, 33, 33, everybody needs to contribute 1/3 of what the additional funds that are needed are. You can't have one person do it and the others not, because that would skew the ownership and create a prohibited transaction. But this is what an IRA LLC looks like. We fund the custodial accounts. The custodian makes the investment in the LLC that you're the manager of. They're the member, and then you're going to have a bank account in the LLC's name and the IN. You as manager have the ability, power of the pen, to make whatever investment you want. It's a beautiful structure, and it's been around for a number of years now. 1996 Swanson case. So well proven out at this point, and a lot of people like this structure. Solo 401ks, I think if you're a real estate broker and you're self-employed without employees, I think this 401k, anybody that's self-employed without employees, this is a structure to use for a variety of reasons. Like I said, we cannot fund the account with a beneficiary IRA or Roth IRA funds, but when you've got that 401k plan set up, you can actually roll over what's in there into Roth if you want. But we will just create the 401k plan. You're going to go to a bank, open an account in that 401k plan's name and EIN. You as trustee have the power of the pen once again. The things I really like about these is that, one, you don't have a trust company. Two, you've got sort of the highest contribution limits short of a defined benefit plan, and no you bet on leverage. Sorry, excuse me. You don't have that custodian. You can literally invest in anything other than collectibles. And the other thing that's nice about them is you can actually borrow funds from them, half what's in them to a max of $50,000. You cannot do that with IRAs. So they're really a wonderful structure, and we do this all the time for people that are self-employed without employees. Rollover business startup. We're a couple minutes over. This pretty much, you got a few examples. There is, by the way, this slide deck will be available for you. If you'd like a copy, reach out to Seymour at 1031exchange.com. She'll get it to you. If you need CE, once again, credit hour for this. And if we're able to provide it for you in your region, she can help you with that too. But a roller business startup, we're just creating this 401k plan, doing a C corporation as well. We're going to move the money in the 401k plan. The 401k plan buys the shares of the corporation. We want you to have, let's say, 5% interest in that anyway too. And then that corporation is going to own whatever it's owning, and you're an employee of that corporation. It's a great thing. Depending on whether it's a new straight up brand new business or a going concern, we're going to look at structuring things maybe differently. Depending upon whether you care whether or not potential employees have the right to buy into your business. Lots of times people have wanted to do this their whole life, and the last thing they want is for anyone else to invest in it. So we have a variety of things we have to go through to talk and make sure we're creating the plan, creating the corp in a manner that gets you where you want to go. And once again, give us a call, take the time, and this is your future, it's your retirement, and make sure that we're doing things right up front and that it's going to get you exactly what you want. Planning is essential, but this is a great tool, whether you're creating some widget company or or you want to go do something, just work on, you do turn and burn properties, flipping properties, and you want to be able to work on and be compensated. That's fine. The rollover business startup's going to work. As I said earlier, the franchise business world knows of this project, and they will definitely steer you to it if they feel that you need some money or you're looking to access some money, and this can be a great solution for you. A few examples were done. So this is just a real estate broker who was sitting in one of my classes one time, and we're talking about potential investments, and she had a builder developer that had run out of money on a project. Well, the project was not able to be sold because it didn't have kitchen and bathroom, and so he ran out of money, couldn't get it done, couldn't sell it, couldn't get loans for it. So she said, well, hey, can I self-direct and go out and buy into this or buy the property and take care of it? And so the answer was yes. And so we created in her situation, this is a number of years ago now, I don't know why we did a checkbook IRA instead of a solo 401k. But she put this thing together, negotiated with that owner to buy the project, said, hey, you sell it to me for this price, I'll give you 1/3 of the net profit on this thing. She put the money in, got the project done, sold it, made $150,000, wrote a check back to the guy for 50 grand. So, he was stuck. She fixed the problem, got it done, had a nice return, invested in what she knows. And I just think it's a very simple example of what is possible. Take advantage of your knowledge and those opportunities that are out there in your world. Second example, this person was just looking to diversify into precious metals, and we've got lots of people doing this right now, obviously. And so in this situation, they're working with and understand that all precious metals don't qualify. It's going to be a purity situation. If you want to do this, you have to make sure, you have to be working with a sponsored dealer, somebody in that metals world that understands and knows it and is going to be selling you IRA 401k compliant investments. You cannot just go buy precious metal and expect that it qualifies. So it's essential you're working with people in that space that understand. Once again, we don't sell this stuff, but if you're looking for somebody to work with, we can help you, get there. But it's got to be IRA 401k compliant. And in this situation, they just want to diversify into precious metals. We put a checkbook IRA together that allowed that to be done and did not require that money be held by the trust companies as depository for that metal. They don't want that. They want to put it where they know where it is and where they know they're going to have access to it if it's needed. So this was a great tool. The checkbook IRA was a nice vehicle in this situation to get them where they wanted to go. The last example is one that I typically use, just I think is so exhibits what's possible in this space. Retired couple comes to us, they want to take their respective IRAs and go out and buy a mobile home RV park. So we start talking about checkbook IRAs because that's what we would typically use for that investment for somebody that's retired. We would have just created, if you think back on the bubble chart, we would have created a custodial account for his IRA, her IRA. We would have done the limited liability company. We would have directed both IRAs to make the investment in the LLC, funding the bank account, and that bank account, that LLC would own the RV park. And that would have gotten them where they wanted to go. Well, as we're going through this stuff, they all of a sudden are alluding to the fact that they want to live there and they want to be the on-site managers and be compensated for it. Both of those things, both are IRA, it doesn't really mean both, but IRA can't even talk. Either one of those things would constitute a prohibited transaction. So we shifted gears from a checkbook IRA to a rollover business startup. And so instead of moving his and her IRAs into the custodial accounts and into the LLC, we created a new 401k plan, moved both accounts into the 401k plan, created C Corp, plan bought the Corp bought the park. They got a job, a place to live, and an investment, all with this one transaction. And I just think that's a prime example of what is possible when you ask the right questions and you're working with people that understand what is possible and have been doing it for a number of years. So don't work with people that are learning on your dime. Make sure you're working with people that have been through it. It's not their first rodeo. It's not going to be their last. IRA Investors Checklist. Plan ahead, takes 2 to 4 weeks to put the account together. You can purchase virtually any investment with an IRA, SEP IRA, Roth IRA, 401k plan. You can purchase with family members, friends. You cannot purchase from or for them. Your IRA 401k plan cannot sell to you or any other disqualified party. You cannot use an IRA 401k plan to buy a property with a mortgage, or you can, I should misspoke. You can do that. It's just got to be non-recourse IRA 401k compliant loan there. Negotiate from the deal's inception, the IRA LLC or 401k plan's name. Do not overextend. Plan on keeping a nice cushion there, because if you buy something and all of a sudden you got an issue and you need more money, you can't just pull money out of your pocket to go fix that problem. Make sure that there's enough there to take care of what you're doing. So with that said, this is David Moore with IRA Advantage. Thank you for taking the last hour and 10 minutes to get here. I got through it 10 minutes over. Sorry about that if you had to go. If you've got questions or concerns, please don't hesitate to reach out. Really look forward to hearing from you in the future. I appreciate take a look at our YouTube channels and like and subscribe. It really helps us out. If you want content on something else, let us know. But our websites contain a lot of valuable information, whether you're looking to sell somebody something in these situations or you're the investor wanting to buy it. The YouTube channels are there too, and they cover a whole variety of things, everything from cost segregation to sell life insurance contracts. It's not just information that directly applies to a 1031 exchange or a retirement account. It's stuff that we find is helpful to people in the investment world, and we really want to help you get where you want to go. So thank you so much for starting 2026 with us. David Moore, IRA Advantage, signing off. Thank you, and Happy New Year to you. Bye-bye.